Hi, everyone. Welcome. Thanks for joining. We're going to wait 2 to 3 minutes before we start, but in the meantime, on the screen you'll see we have a poll about where you invested most of your cash in the first half of 2025. If you could, scan this QR code or going to slido.com, if you put in this code, you can share the results there. So. Um, I'll let you get busy with that and we'll be back pretty shortly. Thanks. Everyone, good evening. Justin here from StashAway. Let's get started. So as I mentioned earlier, we have a poll here for everyone to sort of get some hands-on participation in this webinar. We're asking, where did you invest your cash in H1? Today we'll be talking about, what happened in H1 as well as our outlook for H2. So we thought it'd be good to start with where you all are, have put your cash, and sort of do, a retrospective for everyone. Let me quickly share the results as they are rolling in. So if you can see my screen, I believe you can. It looks like, as the responses are rolling in, most folks are investing in higher risk portfolios, I guess more sort of equity focused portfolios, as well as single stocks and ETFs. So it seems that we have a bunch with a pretty decent risk tolerance here. So as we go through this presentation to this webinar today, we'll have a few more times where there'll be live polls for you to participate and give your thoughts on where, on your views on different sort of market. So let's see, maybe I will let Steph take over the screen again. Okay, great. So again, welcome everyone to our 2025 mid-year outlook, a summer timeout. My name is Justin Jimenez. I'm the head of macro and investment research at StashAway. And we're joined today by our Chief Investment Officer, Stephanie Leung, who, as I mentioned, will be giving a quick recap of what happened in H1, as well as an outlook of where we see you know, things moving in H2 in the summer and beyond. Just quickly before we start with some quick housekeeping rules, I'd just like to highlight that the information presented here is for educational purposes and shouldn't be taken as financial advice. So please speak with your financial advisor or your StashAway client or wealth advisor for tailored advice for your own individual situation. We'll have a Q&A section also at the end. So please, if you have any questions, feel free to drop them in Zoom and YouTube and in the sort of comments or Q&A sections. So to do a bit of introduction about ourselves, we're StashAway. We're a digital investment platform headquartered in Singapore, but present in 5 markets. So we're also present in Malaysia, the UAE, Hong Kong, and Thailand, where we're also regulated by all of the regulators of those jurisdictions. The core of what we do is to make it simple for you to grow your money at a transparent and low cost. That's what we've been doing for about 8 years now, since 2017. These are on the right-hand side of the slide. You'll see some of the sort of accolades we've had over the years, as well as some of our key investors. As I mentioned, we're a digital investment platform. What does that mean? So we see ourselves as a holistic platform to build your wealth. We offer a number of curated solutions for all of your wealth building needs. So first off, at the far left of the screen, you'll see core portfolios. We believe that everyone should have a core investment portfolio. Here we have a few of our products that we offer. We have our general investing portfolios powered by StashAway. Those are managed by our in-house investment team. We also have portfolios powered by BlackRock, which are managed by our partners at BlackRock, as well as the income investing portfolio managed by our partners at JP Morgan. You can also choose to build and manage your own portfolios with our flexible portfolios. And so those are our core portfolios. We also offer cash management solutions in all of our markets, as well as thematic portfolios. And for accredited investors in Singapore and professional investors in Hong Kong, we also offer private market products. So, if you're still figuring out what portfolio is right for you, what product is right for you, we may be sort of known or called a robo-advisor, but we have, very real human beings here to help you. So you can always get in touch with our client experience team if you have any questions. So just a bit of maybe what we've been up to behind the scenes over the past 6 months of 2025. We behind sort of this product, we have a lot of sort of small, I guess, milestones. So just this sort of highlights the things that we've done over the past 6 months. So for example, now from the start of the year, investors in Malaysia can now access crypto ETFs in our portfolios via our flexible portfolios. You don't have to be a high net worth individual. It's available for everyone. And we also launched in our Malaysian sort of market an eKYC solution to make it easier to onboard, make a seamless and effortless experience for you all. In March, we also sort of jumping forward, those crypto ETFs are now available to accredited investors in Singapore on our flexible portfolios. In April, we launched private credit in our app. So now our high net worth clients in Singapore, Hong Kong, and Dubai can see all of their private credit investments on app. And now you can also sort of see deposits that are pending to be invested in your account. So you have full transparency and visibility into cash, on your cash from the moment it leaves your bank account and to the moment it's invested in our StashAway ecosystem. In May, we revamped our website. We in Singapore we launched, if for those of you in Singapore, a brand campaign called "You Do Life, We Do Investing." So you handle what's important for you, and we'll handle building your wealth for you. So we remain committed to that. Set it, forget it, and we do the rest for you. And so the latest sort of developments this past month, we launched semi-liquid private equity and infrastructure products for our AI and professional investors in Singapore and Hong Kong. And we also have some new products, new developments on board. We beta launched sort of an ETF platform, what we call in Singapore. And for our users in Thailand, we also have some enhancements via Line. So it's been a really eventful past 6 months for us as we work towards enhancing our product offering and overall experience for the platform for all of our users. And our roadmap for the rest of 2025 is even more exciting. So please stay tuned for that. And after that spiel, let me turn the mic over to Steph. So I'll just leave it to you, Steph.
Sure. Thank you very much, Justin. And again, welcome everyone to spending your night with us. Tonight, I'm planning to go through a review of the first half in terms of markets, and of course, like how we did in terms of StashAway portfolios. And then we're going to go into a quick session into how we think about the markets over the next few months. And of course, I will leave plenty of time for Q&A so you can get all your questions answered directly on this call. So without further ado, let's jump in. First of all, I think if you all remember, at the beginning of the year, we put out a Outlook piece. It's titled "Fat is the New Normal." And everybody remembers FAT, FAT, but probably worth reminding everyone what FAT stands for. So FAT basically stands for fiscal dominance, artificial intelligence, and Trump policies. I think perhaps the latter two is actually quite self-explanatory, but perhaps let me spend a bit more time on fiscal dominance. And what we mean by here is that if you think about what are the policies that impact markets over different periods, there are different emphasis in terms of policies. For a very, very long time, indeed, since the financial crisis, what's been driving the markets has been mostly monetary policy, meaning you always hear about, what is the central bank doing? What does Powell say? Is he going to increase interest rate, decrease interest rates, or do QE, QT, etc.? All these are the central bank's way of using its tools to sort of, help the market or help the economy to navigate its ups and downs. We think that has changed, right? Since COVID, we've seen an expansion in fiscal policy, meaning that a lot of the kind of spending is directly coming from the government. So we all know that Trump just passed the 3B, the big beautiful bill, just now. It is a very, very good example of what we mean by fiscal dominance. Basically, the governments are spending more and more in order for them to kind of smooth out the economy, or you can argue that they're trying to kind of keep growth high for the economy running for a longer time. And the effect of this is not just in the US, right? In Europe, even in Germany, we've seen a change in stance in the sense that governments worldwide are spending more on direct infrastructure, for example, or direct welfare, as in tax cuts, etc. And the implication of this is actually quite far-fetched, which we'll go into later. But this is basically what we mean by fiscal dominance. AI is, of course, another very, very important factor. We don't think is a fad. We don't think is is a bubble that comes and goes. Indeed, we think that the AI impact is actually as important, if not more important, than what we've seen with the invention of the internet back in the 2000s. Of course, in the 2000s, we also had an internet bubble, which I mean, brought a lot of companies to sky high valuations, only then to sort of burst, and I mean, our whole industry suffered for a few years. But after that, some of the best companies and some of the best sort of technologies actually came out. If you think about the Mac 7 today, all of them are actually beneficiary of the internet era. We think that this is actually another wave of technology that will impact not just the few companies that are developing it, but also kind of much broader set of companies and arguably the economy. So artificial intelligence is the other big theme that we think that, I mean, we're tracking, and also we think that investors need to track over the coming years. Lastly, Trump policies. I mean, obviously, we've had a lot of Trump in the last few months. We expect that to continue, even though I think a lot of the kind of volatility has played out already. But still, I mean, Trump can drive a lot of longer term implications, particularly on the currency, which we'll go into later. But basically, what we've seen so far in the first half of the year is that the FAT framework actually has continued to play out. So going back to markets, in the first half, I think the biggest surprise to a lot of market participants was the reversal of US exceptionalism. What we mean here by US exceptionalism is basically the idea that US equities, US assets, US bonds, etc., US dollar would continue to outperform the rest of the world. And I think that was a very, very entrenched belief at the beginning of the year. However, of course, with Trump policies, with kind of the trade tariffs, and more importantly, I think with overvaluation of these US assets, I mean, that trend has reversed, and it has reversed in a very, very violent manner. If you look at the chart on the left-hand side, this is a 10-year chart plotting the S&P versus global equities ex-US. So you can see over time, the US is actually on an upward trend versus the rest of the world, meaning that US equities actually outperform the rest of the world quite meaningfully over time. However, you can see that there's a spike at the end of 2024. I mean, that was when everybody got actually quite, I guess, overextended and overexcited about US outperforming. So what we've seen in the last few months has been an unwind of this position. And if you look at kind of how this line compares to the long-term trend, you can see that now it's sort of back to the long-term trend. So a lot more kind of reasonable in terms of where the US is versus global equities. Similarly, if we look at year-to-date returns on the right-hand side, you can see that global equities ex-US has returned 17.7% compared to US equities only 6.2%. So I think the lesson here is maybe twofold. Number one is that it always kind of pays to have globally diversified portfolios. Because even though, yes, I mean, you can actually overweight US over the long term. I mean, during these short-term gyrations, I mean, these are when a lot of the kind of volatilities would happen. And having a diversified portfolio actually helps you to stay invested, to not experience these very, very dramatic reversals, and also to help you to stay invested over time. The other aspect of reversal of US exceptionalism is, of course, the US dollar. And you can see here, again, we look at things from a very, very long-term perspective. So when we plot the US dollar over a 10-year time horizon, you can see that there are kind of periods when the US dollar is more expensive. There are periods when it depreciates. However, currencies mostly, or if you think about the US dollar, look at it from a long-term perspective, is actually a zero-sum game. And when what we had at the end of 2024 was a overextension of US dollar. And today, I mean, the US dollar is actually back to its long-term average. Again, it's a reversal of some very, very overextended positioning. One thing that really stood out, and I mean, I think we've been sort of talking about for quite some time, is gold really outperformed in the last 6 months. If you look at the left-hand side, you can see that there are four major asset classes. These are the four major asset classes that our StashAway portfolios actually invest in. And on the top, you can see a gold line up 24.4%. That is, of course, gold. And it has outperformed other major kind of equity markets and also bond markets. On the, I guess the underperformance line, like the flat line, is ultra short dated U.S. Treasuries. These are sort of cash equivalents. So if you kind of look at 2.1% return, analyze that, that's around 4%. So this is basically giving you a U.S. risk-free rate return. And all portfolios use these four asset classes in different mixes. For our higher risk portfolios, we have more equities and equities mixed with gold. And then for our lower risk portfolios, we have gold, we have bonds, and mostly also we have cash equivalents. But in general, I mean, all the four major asset classes are in green. All of them are up, but gold really shined. One of the reasons of why, I guess there are multiple reasons why we have included gold in our benchmarks. One of them has been central bank buying. And if you look at the right-hand side, central banks globally has actually been very, very consistent buyers of gold, I guess, for the past few years. And indeed, if you look at the bottom chart, we can see that quite a number of central banks are still buying. One of the major central banks that has been buying is actually China. And you can see that, I mean, China in the past month still is the top three, among the top three central banks that are buying gold. So, for those of you who have been following StashAway for quite some time, you may remember that StashAway actually started to include gold in all portfolios starting April last year. And the reasons were, of course, number one, that I mean, we think gold over time is a very good safety asset. I mean, if you look at kind of whenever equities sell off, I mean, gold actually provides very good protection. It doesn't sell off as much as equities, and actually in most of the episodes, gold has gone up, so it provides very good protection. And that is why if you look at our all our StashAway portfolios, if you think about our StashAway kind of neutral allocation, meaning that what we put here is our benchmark across kind of the full cycle. I mean, this is the allocations you should expect StashAway portfolios to have. And throughout the different SRIs are different risk levels. I mean, we have different levels of gold included in these different risk portfolios. And if you compare that to the traditional benchmark of only equities and bonds, you would be able to see that what we've actually taken out, like what we've actually allocated away, is global bonds into gold and into these ultra short treasuries. And this actually helps to explain, I mean, why we've been doing better than equities or bonds in our across our StashAway portfolios. So this chart here shows you the three sort of I would say bookmark sort of portfolios. And these three represent our most aggressive portfolio, which is SRI 36, our most conservative, which is 6.5, and our moderate risk, which is 22, how they've done kind of in the first half of the year. First thing I would like to highlight is that all of them have returned positively throughout the 6-month period, with the most aggressive SRI returning 11%, the most conservative returning 5.6, moderate returning sort of 10.8. So on average, our portfolios actually return 9.3%. The second thing I'd like to draw your attention to is actually during April. I think we all remember after Liberation Day, there was a pretty painful and quick sell-off in markets. And during those periods, our StashAway portfolios have actually done decently well in terms of managing drawdowns. And on average, our SRI portfolios were only down 5.8%. This compares to global equities down 16% and global bonds down 2.2%. So again, I mean, the allocation in gold gave us quite a bit of protection. And also, I mean, some of the other off-benchmark allocations have given us these protections as well, right? For example, our allocations to defense have actually helped portfolios this year so far as well. So another way to look at it is from a risk-adjusted basis. What is our return? I mean, this is commonly called the Sharpe ratio. I wouldn't go into detail here, but I guess what we can see here is our portfolios have deliver a 2.4 times return for every unit of risk that we take. And this compares more favorably than a traditional equity bond benchmark, which stands at two times risk-adjusted returns. So this table here shows you the full returns for all our SRI benchmarks. I won't go into detail here, given that we just talked about it. But all this information is available, and you can actually, you can actually get all these data from our first half return communication piece article, which we're going to publish, I think, over the next few days. The other aspects I would like to draw our attention to is, how diversified our portfolios are. This is an example. I drew it from our SRI 22 portfolio, which shows you kind of all the different ETFs and also, to a certain extent, these different asset classes that we've included in a moderate risk portfolio. I mean, you can see that it ranges from gold to sort of to aerospace and defense, to technology, to Japan, et cetera, et cetera. So again, going back to my point about having diversified portfolios, what we're trying to do here is really to build robust portfolios using these different building blocks that we think could add returns over time. Very quickly on our other portfolios on the platform, BlackRock portfolios have returned on average 6.6% year to date and 11.3% on a rolling 12-month basis. Our thematic portfolios have done decently well this year. Year to date, technology enablers have returned 11.1%. Similarly, for future of consumer tech, environment and clean tech is actually the one that has returned the best, up 12.8% on average. Healthcare innovation has actually been lagging this year, returning only 1.3% year to date, given that healthcare sector has been lagging the overall market. So with that, I would like to go into second half outlook, but actually before that, I'd like to do another poll so that we can get your thoughts as well. So the question here is, what is your view on risky assets? And we have three options for you: bullish, bearish, neutral. Very, very simple. I guess maybe we'll just give a minute or two for everyone to respond. Okay, I'm seeing kind of polls coming in. So perhaps I'll just switch over and show you guys what we think as a collective unit. All right, I actually like the results a lot. I like that we're bullish. 56% of us are bullish, 31% of us are neutral, 13% of us are bearish. So I think majority of us actually have a pretty sanguine view of the world, which as investors, I guess over time, because things tend to go up, the bullish crowd typically wins over time. Of course, there are times where the bearish crowd wins, but these are kind of shorter term gyrations. So let me go into what we think and see if it matches or kind of create some controversial discussions with what you think. So I think if you roll back to the first half, a lot of things have happened. Obviously, we had a big sell-off in April, and with sell-off, typically you see volatility in markets spiking, meaning that markets actually move around a lot. And that is typically measured by something called the VIX, and it measures volatility of the U.S. market. So here you can see two lines. And the purple line is actually called the U.S. Trade Policy Uncertainty Index. And you can see here that actually the VIX has correlated quite well with this U.S. Trade Policy Uncertainty Index year to date. So a lot of the uncertainty or a lot of the volatility in the market has actually been driven by U.S. policies. And if you look at kind of most recently, I mean, the US policy uncertainty index has actually died down quite a lot. And with that, the market has calmed down already. So I think this actually shows you what has been driving the market sell-off in April. And I mean, perhaps this is actually one good data point for the bulls. Secondly, what has been driving the very, very quick recovery in markets? Actually, if you dissect different investor groups, what we've actually analyzed is that passive flows from corporates have been supporting the rally in US equities. And if you look at the left-hand side chart, you can see that these actually plots the monthly time series of corporate buybacks. This includes US buybacks and non-US buybacks, but majority of the buybacks have been coming from US companies that are very, very cash rich. So in the second quarter, actually starting from April, you can see that US companies have been really stepping up in terms of of buying back their shares. And I think that has provided very, very good support for the recovery in subsequent months. If you look at the right-hand side, I've actually taken out from CNN something called the Greed and Fear Index, and it measures how I guess how overbought or how oversold the markets are. So as of yesterday, the market is in the greed territory, but it's still not at extreme greed. So I think there may be some. I mean, there has been a lot of corporate buybacks that has driven the rally. But for example, I mean, retail investors have largely been on the sidelines, and we think that the next phase of market upward movement may be driven by more retailers coming in. However, it doesn't mean that markets don't go up in a straight line, right? So I think what we're expecting is perhaps some consolidation in the summer, particularly as we go through the earnings season, because typically, I mean, corporates have a blackout period. They can't buy back shares during the earnings season. And also, of course, I think investors need to digest corporate numbers from the first half. So we wouldn't be surprised if we see some sort of consolidation, but that actually doesn't create a substantial risk in terms of, I guess, more significant pullbacks. If we look at ERA has been in a inflationary growth regime, and for those of you who are like maybe first time not very familiar with ERA stands for Economic Regime Asset Allocation Framework, and this is the predominant framework that we use to construct our portfolios. So basically, it divides the economic cycle into four quadrants according to where we are in inflation and growth. And today we are in high inflation but positive growth territory, which is called inflationary growth, which is a regime typically quite good for equities, not so good for bonds, but also good for commodities, hard assets such as gold. So I think if we look forward to the next few months, we expect this inflationary growth regime to perhaps remain. And in fact, if we look at history, today this inflationary growth regime that we've experienced in the last year and a half has been actually one of the longest inflationary growth regime that we've seen in the past, perhaps in 20 years or so. And this is because inflation is still quite sticky. And this is quite a big change from what we've experienced in the past 20 years. And a lot of that is, of course, driven by I guess fiscal policies during COVID, but also, of course, driven by trade tariffs, and also in the coming kind of big beautiful bill, as we talk about fiscal dominance, that drives inflation high as well. So if we look at the left-hand side chart here, you can see the latest PMI figures, and we like actually referring to PMI, which is the Purchasing Managers Index, because it's a very, very real-time indicator of how the economy is doing. And this PMI price changes basically signals where inflation could be in the next few months. And on the left-hand side, you can see United States is the gold line, and rest of the world is actually in the green. And US is the place where inflation is spiking. And if you overlay CPI, US consumer price inflation on the right-hand side with the PMI price changes. PMIs tends to lead about 4 months. So we wouldn't be surprised if the next few months US CPI actually starts to pick up again. And that presents a trickier situation for the Fed, which we'll talk about later. I guess if we kind of just ignore the short-term like trade tariff impacts, because trade tariff is actually a one-off thing. So once you've got through the tariff, I mean that inflation actually don't repeat again, because inflation is a year-on-year number. So once you get past that hump, then I mean trade tariffs actually have no impact. However, if we look at some of the, I guess some of the global economies, and most importantly Japan. The reason why Japan is interesting because Japan has gone through a 30-year deflation, as we all know. However, starting from 2023, as you can see from the chart on the left-hand side, Japan's CPI has actually become above BOJ's target. And it seems like that's here to stay, right? It's actually the inflation in Japan is real and it's sustainable, it is staying. What does that mean, right? What is the implication? If you look at the right-hand side, this is the bond yield on Japan government bonds. So today, Japan government bonds is actually giving you 2.85% in terms of yield. And if you just rewind that about a few years ago, Japan bonds is actually giving zero yield. So that zero yield environment, that ZERB environment is gone, partially because the world's most deflationary economy is no longer in deflation. And if you look at kind of this 30-year bond yield is now back to where it was in the early 2000s. So Japanese bond yield is actually supporting kind of global bond yields, particularly as US still has to fight an inflation problem. And I mentioned the Fed. Actually, the Fed may have a difficult mandate over the coming months because of perhaps a stickier inflation. And this is a chart that shows you it's a survey of FOMC members who vote for rate changes. And every month they get asked, I mean, where do you think your inflation forecast, where do you think your growth forecasts are? And do you think there's upside risk or downside risk? And if you look at the very, very right-hand side, actually for inflation, all the FOMC members think there's actually no FOMC members think there's downside risk. So nobody is thinking inflation is going to come off very, very quickly. Also, not shown here, but no FOMC members see downside risk to the unemployment rate either. So it seems like FOMC is not worried about growth, but it's more worried about inflation, which supports their policy tilts to take their time in terms of cutting rates. And indeed, if we look at some of the hard data on US growth, actually US consumer, US growth remain very, very resilient. Here is a core retail sales time series, and basically it is very, very real time. I mean, the latest number from early June, I mean, still tracks about 4% in terms of retail sales, which is still very, very healthy. However, I think if we have to think about risk, I think one of the biggest risks is, of course, a labor market slowdown. And if you look at on the left-hand side, global PMI unemployment or employment index has been trending slightly weaker. But more importantly, if you think about the impact of AI, I think that may start to impact a lot of software companies, if not other sectors. Microsoft just announced a pretty significant layoff of about 20,000 people. I think that's the second time they've done it in the past 12 months. And if you look at on the right-hand side, this is a chart that shows you the Microsoft employee count. And it's interesting that it's shaded into three kind of macro, I guess, macro periods. ZERB was the zero interest rate period, and everybody, because they can borrow money very, very cheaply, just expand it, right? You can just afford to hire a lot of people and expand your business. And that's what Microsoft did as well. And into 22, I think a lot of us remember that was the year when there was a pretty sizable tech sell-off in the equity markets, and everybody was talking about getting fit. Mark Zuckerberg was firing people at Meta, and including Microsoft as well. Right? So they did a hiring freeze. And then in 2024, when AI boom started, Microsoft started hiring again because they need to get ahead in the AI race. Interestingly, in the past few months, we've seen that reversal happening. And a lot of that has to do with AI automating a lot of the work that people at Microsoft do. A lot of people actually are now using coding agents to automate their coding or to kind of help them with producing more. And I think this is perhaps one of the key trends that we need to be watching. So are we worried? We're not too worried because we think that even though there could be a labor market slowdown, we see very little risk of a recession, and that's because the U.S. corporate is very, very strong. If you look at the left-hand side, this shows you corporate sector debt as a percent of GDP, and as of 2025 Q1, I mean, U.S. corporates are actually very, very low in debt. If you look at the number is 31%, which is kind of perhaps, I mean, among the lowest in the past kind of 40, 50 years. And if you look at the gray areas, which are recession areas, those periods were typically preceded by a significant increase in terms of corporate debt. Today, we're still far from that. And then on the right-hand side, you can see corporate profits and also S&P 12-month EPS, and of course the equity index, which corresponds to very, very well with corporate earnings. So you can see that all three lines are actually trending higher. And given that the US corporate is still very strong, we don't see a significant risk of a recession. So, I mean, what does that mean, right? And that actually brings us back to Fed and how everything is going to play out in second half. So back to fiscal dominance. I guess, yeah, one of the surprising or not so surprising thing that happened was, of course, bye-bye Elon and long live the big and beautiful. I mean, there has been, I think, some efforts at administration to actually try to cut costs before they put the big beautiful bill to approve to the I guess Senate approval. But now that the approval is done, if you look at kind of where that is going into, most of that is actually going into tax cut extensions, and some of that goes into defense borders. But this is basically a 3 to 4 trillion addition to U.S. debt, which stands at 36 trillion today. And this is a chart that we've shown before, which is the estimation by CBO at the U.S. government on I guess the U.S. debt as percentage of GDP going forward. And if you look at kind of the right-hand side of this chart, it's not a pretty projection. Basically, it's a straight line up in terms of how much more debt U.S. is going to incur in relative to that GDP. And a large part of that has to do with this 3 to 4 trillion that we've just passed. What is the implication of this? I think we've actually mentioned that quite a few times and reflected also in our asset allocation, is that bond yields are unlikely to fall, especially long-term bond yields are unlikely to fall significantly. Number one, because of course when the economy is strong, bond yields actually tend to stay high. And secondly, I think given the chart that we've shown before, there is increasing concern about the sustainability of U.S. debt. And this is a chart that shows you the 30-year interest rates on U.S. Treasuries, U.S. debt. And I think we've tested 5% 2 to 3 times. I wouldn't be surprised if we kind of test 5 again. And the question is 5 a defendable number? This is one of the biggest mandates that Besson has. And unfortunately, I don't think he has a lot of tools to defend this 5%. So once if U.S. interest rates do break 5%, I think that creates a lot of question mark in terms of whether U.S. bonds is still as a safety asset as people would have thought. And that explains also why gold, for example, has rallied 30% year to date, and also other commodities, other precious metals that are following. In terms of AI, as I mentioned, I think this is still an ongoing kind of, I guess, revolution or significant change that that would impact a lot of different companies. We think the difference this year is that it's shifting to second gear. And if you think about the last 2 years since we all first heard of ChatGPT, the way to invest in it was mostly through NVIDIA, if not the Max 7. And I mean, of course, the Max 7 has done very, very well. But I think year to date, if you look at the bottom chart, which shows you the relative performance of Max 7 versus ex Max 7, US equities, Max 7 actually still is underperforming the broader market. And when we look at what's been performing, what's been kind of making new highs, I mean, these are companies that are much more on the application layer. These are companies that can use AI to either cut costs or to increase their revenues. And if you look at the next generation kind of AI companies, I mean, they are like sort of, I think they're sort of emerging. Uh, and this chart here shows you how we can think about all these different types of companies. So on the top, for example, these are model companies. These are names that we know very well, right? OpenAI with ChatGPT, Anthropic, Grok, etc. I mean, these are companies that are building these foundational models. And they've grown very, very well, right? They've grown actually 4 times year to date. But there are other companies that are much smaller today and that could potentially even actually grow quite a lot over the next few years. For example, some of the software infrastructure companies, the application layers companies, the robotic companies, and also some of the semiconductor companies. For example, I mean, not just NVIDIA, but also a lot of custom chips and, for example, kind of cooling solutions, data center solutions. I mean, these are companies that will still benefit from the ongoing AI boom. And what we've seen so far is a significant increase in the usage of AI that drives significant increases in a lot of these companies, in a lot of these valuations for companies. Like, for example, on the bottom, you can see OpenAI actually doubled their valuations in 6 months, and Anthropic actually quadrupled their valuation in 12 months. And these are kind of supported by the increase in their revenues. Unfortunately, a lot of these are happening in private markets. So as public investors, it's perhaps harder to access these companies. But I think what's encouraging is that this year so far, the IPO market in the US is doing quite well. So hopefully, I mean, that kind of prompts more companies to come to IPO and be able to provide public investors with investment opportunities. But regardless, even if you can't invest in OpenAI, I mean, tech first companies are going to be beneficiaries. And I mean, this is a chart that is a very, very well-known chart for everybody here. It's basically a chart of QQQ, the NASDAQ index. And I think if you look at kind of long-term NASDAQ since the financial crisis, it has done extremely well. And if you look at NASDAQ on an annualized basis, basically every year it has returned 19% annualized. So every year it returned 19%. Now, of course, if you compound that, that is why it has basically gone up 10 times in the past kind of 15 years. And this trend seems to be quite intact, right? This trend has been driven by different things and different sort of time horizons, but always it's been driven by technological innovation in the US. So lastly, and just very, very quickly on Trump policies, I think as I shown in the first chart, a lot of the kind of, I guess, policy uncertainty has passed us already. But of course, there are still ongoing tariff negotiations. So far, the negotiations have been going very, very slow, right? There's only been basic frameworks agreed with the UK and Vietnam so far. But I think what we've seen is also that the administration is trying to kick the can down the road. So they extended again July 9th deadline to August 1st. So I think the impact that we're going to see from these tariff negotiations are going to be smaller and smaller compared to what we've seen in April. I guess the other area which could potentially draw some attention is immigrations, because Trump is actually stepping up on his mandate to take people out of the U.S. and also to secure the border. And indeed, if you look at the right-hand side chart, the number of people held in immigration detention has actually started spiking in the past few months, and I think that would probably continue. Lastly, which is perhaps the policy that we're most hoping for is more deregulation, particularly for the banking and energy sectors. I mean, this is something that Basson has promised in the second half of the year once he's got like the trade tariffs actually done. So we would expect more, I guess, more announcement on that front in the next few months. So one of the things that we get asked a lot and most people care a lot about is actually Trump's US dollar policy. Is he going to significantly depreciate the US dollar? And to that, I mean, we can look back in history, right? And I think the last time when the US actually did a very, very significant US currency depreciation on a policy-driven kind of mandate was back in the 1980s, 1985, there was something called the Plaza Accord. And back then, basically what the US did was, okay, let's all get together and let's agree that, I mean, we will take the US dollar down. I mean, you guys, Japan, Europe, you all have to appreciate your currency to help the US economy. And that was what caused a very, very dramatic depreciation of US currency here. As you can look at, you can see on the left-hand side, basically the US dollar depreciated versus the euro versus the Japanese yen in a very, very quick fashion. And I think if you look at the situation back then, and look at the GDP growth rates of these three different major economies in 1985, Japan was actually growing very, very quickly. And that's why there was room for Japan to appreciate the currency. I mean, Germany back then was also growing, I guess, quite in line with the US. At least, I mean, they're quite at par. Today, I mean, if you look at the right-hand side here, number one, these currencies are not as extended. And number two, I think US still remains the world's strongest economy. I mean, European economies are still like kind of at the brink of being in recession or no recession. Japan, yes, I mean, there are some green shoots, but still there's a lot of question mark as to, I mean, how sustainable the Japanese economy can be. So US by far is still the strongest economy. And with the US economy being so strong, there is less of an argument for US dollar to depreciate, or it's harder for all the other countries to agree to it because everybody loves to sort of have a weaker currency to support their growth. And most importantly, I mean, China today is in a very different situation compared to Japan or Germany back in 1985, in the sense that the China economy is actually also very, very weak. And China is still very reliant on exports. So I think it's much harder for Trump to force a currency appreciation for their trading partners. So with all that, I guess let me have a quick wrap and talk about some of the key takeaways. Number one, we think that, I mean, there could be some short-term shakeup this summer. It's if we see kind of labor market weakening or if we see corporate buybacks slowing, I wouldn't be surprised to see maybe a consolidation, perhaps a 5% or so correction in equity markets. But this is actually not nothing to be panicked about. And indeed, we think that FAT continues to play out and it favors equity and hard assets versus bonds and cash. And going back to, I think, what a lot of us have indicated, I mean, this is actually quite in line with a more bullish stance on risky assets. Some of the market segments do appear to be a bit stretched, but others are catching up. For example, I mean, US Tech Max 7 has been underperforming. Maybe this period, if you're not in a diversified portfolio, is a good period to sort of think about how you diversify. And taking advantage of our pause may be more effective in chasing markets. And let's see if the market gives us a chance to actually add more to risky assets. So lastly, what can you do? Stay invested. Remember, market volatility is normal. I mean, these kind of 5%, 10%, even 20% corrections happen every now and then. They happen on a different frequency. Of course, the deeper corrections happen less frequently. But these are corrections that eventually recover, and time in the market is always more important than timing the market. And also think about your strategic asset allocation, think about your risk. The reason why we have all these different SRI levels is that we would like to cater to all the different needs of your different time horizons and your different goals, and also most importantly, your risk appetite, right? Can you sleep at night? Dollar cost averaging is a very, very good tool for you to get through these different market conditions. And I would say, I mean, just start dollar cost averaging today if you haven't done so, because who knows, right? The market may correct, the market may not correct. And if it doesn't correct, it doesn't give you an entry point to the next 10 years of bull market. So I probably won't go through this, but I mean, like these are kind of, I guess, investment mantras that we talk about all the time. If you're holding too much cash, you're missing out on the additional returns. So remember to kind of review how much cash you actually need. For the rest, invest it either through lump sum or DCA. So with that, I mean, we've talked a lot about how we think, and hopefully that gives you some food for thought. So with our final poll before Q&A, or actually maybe during Q&A, I'd like to ask you the last question. What is your investment plan for 2025 second half? Do you plan to buy the dip? Do you actually listen to us and set up a DCA plan or continue the DCA? Or if you're bearish, are you looking to reduce investments? And D, do you have maybe some of you are still wondering and you don't have a plan, and I may want to talk to one of our I guess clients experience and also wealth advisors. So maybe I'll leave the Slido up and we can review the results after the Q&A session. Does that work? Should we start the Q&A, Justin?
Sure, let's do that. There's a lot of great questions from our viewers on Zoom and also
Sure.
on YouTube. So yeah, why don't we just get started on that?
Yes.
I sort of tried to group them together into different themes just to
Yep.
make everyone's lives easier. We have a couple questions, just given sort of how we think about asset allocation and our GI portfolios, given sort of the current market environment. So one of Marcus is asking how are we adapting given elevated interest rates, persistent inflation uncertainty, central bank narratives changing. How are we thinking about GI adapting asset allocation to maintain that risk-adjusted return?
Yeah, so I think if I take a step back, the way we manage our portfolio or adjust GI portfolio is from a macro perspective. So as I've shown, like in one of the slides, we have 4 different quadrants in terms of macro conditions, and whenever we see a change or a shift from one macro regime into another macro regime, that's when we would actually tilt or change our portfolios. So I guess of course, like when the regime happens, we'll have to run our system and run our numbers to see what are the best kind of combinations and best ETFs to be included. But just very, very broadly speaking, let's say today we're in inflationary growth, right? Let's say we go into a stagflation. So in a stagflation, actually growth comes down, inflation remains quite high or even go higher. In that case, equities tends to not do so well. So we would probably cut down on our equity allocation. And typically in those kind of regimes, your hard assets, the commodities, gold, even energy or kind of energy-related sectors or countries, and those would do quite well. So in that case, we would actually increase allocations to those asset classes. Now, when you go into recession, typically in a recession, bonds actually perform very, very well. So in that case, we would probably shift our allocation from gold into bonds because bonds would actually be much better in terms of protective assets than gold. And then the last quadrant is, of course, good times. Good times, as the name suggests, is actually the best time for owning equities. And very, very likely then we would actually shift our bond allocation back into equities. So this is a kind of a ongoing economic cycle. And I mean, as a broad kind of idea, that's how we would adjust our portfolios.
Great.
And of course, one more thing to note is that
Yeah,
we have also a very robust set of risk metrics that guardrail how much we can deviate from our like benchmarks from our strategic asset allocations. And also, for example, how much we can actually allocate to one particular ETF or one particular asset class at a maximum. So that helps to ensure that even though we do these tilts, we don't take excessive risk. And of course, the SRI is a very good framework for us to kind of think about how much risk we can take. Ultimately, the reason why we tilt all these different asset classes is that we want to maintain a very similar risk, a constant risk throughout these regimes. Because if you think about a recession, in a recession, of course, like equities carry much higher risk than in a good times. And that's why we need to kind of reduce our equity allocation when the risk is higher.
great. Got it. Um, Kind of continuing, kind of maybe deep diving into a particular asset class, into equities. We have a
Mm,
sort of a few questions on sort of related to what you were talking about, U.S. exceptionalism waning and the divergence between U.S. and non-U.S. equity performance. Mi-Hoon Hui is asking about, how do you think about that over the longer term, the opportunity in global equities, um, given the risks that are associated also with currency volatility, geopolitical tension, maybe slower earnings growth with the US? How do you balance that sort of
mm,
one exposure to global equities, but also
yeah.
the US as
Yeah,
well?
yeah. So I think there's a few things that are going on in that question. So let me
Yeah.
take it kind of one by one. I think the first question is of course the currency, and I think it really depends on like as we've seen, the U.S. dollar has actually depreciated very very quickly in the past sort of 2 to 3 weeks. And that creates problem for non-US dollar based investors because if you are, let's say you are denominated in euro, even though the S&P has gone up, like, let's say 10%, if US dollar depreciated by 5%, it means that your dollar adjusted return is only 5%. So it actually detracts from your investments and it decreases your the attractiveness for you to invest in US based assets. And I think that the way to think about it is number one, if you look at your portfolio, most people actually have a local currency bias, meaning that you're actually underweight US dollar or you underweight foreign currencies. Why? Because I mean, most likely maybe you own a property in your local market, maybe you own some stocks. So US dollar as a total of your total portfolio may not be as big as you think. And so you may ask, what is the right level, right? So the one way to look at it is like how the world is divided into US dollar versus non-US dollar assets. So if you look at the global equities, everything like all the companies, all the stocks added together, US is actually about 60% of global equities. In terms of fixed income, US is actually about 50% of global fixed income. So a neutral allocation to the US is actually about 50 to 60%. And so the first thing you need to ask or review about your portfolio is, so how much US dollar exposure do I actually have? For a lot of us, maybe it's a lot lower than 50, 60%. Then, I mean, that currency depreciation or appreciation actually does not matter as much as you think. The second point I'd like to make is, as I've shown in one of the charts, currency is sort of like a zero-sum game over time. So it also depends on your time horizon. I think if you think about kind of a much longer time horizon, particularly for example, for our Singapore-based investors, actually the currency gyration over time just comes back to a flat line. So over time, it doesn't matter that much to your overall return. Of course, in the short term, you will see gyrations. And then I think apart from the currencies, then the next question is about how do we think about like the increased risk of geopolitical tensions, like trade tariffs, et cetera, et cetera. I think this actually argues for even more for diversification because um, if you think about technology, say take AI, right? Of course, the US is actually the leading kind of country in developing like cutting edge AI technology. But because of like these geopolitical concerns, because of trade tensions, China and the rest of the world, like you can see also in the Middle East, for example, everybody will be trying to build up their technology stack. And that also benefits the local kind of technology sectors, that also benefits the companies that are developing locally. So it gives you, as an investor, actually more opportunity to diversify. And I think that argues favorably actually for a well-diversified portfolio. Maybe I'll just stop here because it's a lot. I'd like to leave like more time for other questions.
No, for sure. Okay, maybe I'll leave it. Do you have, we can either stick to equities or we can go to fixed income. Um, Maybe let's have one more equity question. There's a
Okay,
question from SK.
sure. Okay.
She's asking about Europe. Is it a good time to increase exposure to Europe indexes using DCA?
hmm Yeah, I think um, a few things have changed in Europe, and these are major changes, right? We're not talking about very short-term changes. The most important thing is, of course, the change of mindset of the average, I guess, voter in Germany. So what does that mean, right? Why is it important? Because it prompts the government to open the tap to spend, uh, and uh, and that's why we've seen these announcements coming from Germany, and because Germany has actually been the most fiscal prudent government in the EU and arguably globally as well. And when Germany starts to spend, it basically gives like a green card, a gold card for all the other governments to sort of follow. And I think that actually opens up the opportunity for more kind of government-driven growth, particularly in areas like infrastructure, new energy, etc., technology, etc., in Europe. Because one of the reasons why I guess European growth has been quite slow is because of the sort of I guess of the more stringent regulations, of the more stringent sort of government controls for these sectors compared to the US. Now, of course, there are still structural issues in Europe. For example, we all know there's a demographic issue. The European Union is just a monetary union. It's not really a fiscal union. There are like sort of regulations, red tapes, et cetera, and these are not going away. But I think from a Delta perspective, it is indeed a very exciting kind of change. And also given that European companies are still fairly decently valued compared to the US counterparts, I think there's still opportunity for money to flow back into Europe.
Great. Maybe I can just do a quick plug here. So every month we put out a note called CIO Insights where we dive into different topics. In May, we actually deep dove into the topic of Europe. So if you want to sort of learn more on our views on Europe more broadly and even more granularly into different sectors, different countries, I definitely encourage you, SK, to take a look at that. That's on our website. Also, you can find that in app. So yeah, Steph, like I said, let's maybe switch gears from equities to fixed income. We have a few
Oh,
questions from the audience. Maybe let's start with the short end of the curve. So Gaurav is asking, how do you see the outlook for basically, sort of 0 to 3 month US Treasuries, the sort of shortest, ultra short end of the curve?
yep.
How do you think interest rates will change sort of in the coming period ahead? Let's.
Yeah. So I think the market is sort of penciling in about 2 times of rate cuts into end of the year. I think that's probably reasonable. But of course, the risk is that they cut less because of the inflation potential for inflation to go higher in the next few months that I talked about. Um, I mean, the Fed is running. If you think about how tight the Fed is in terms of their policy, one very good way to look at it is from if you look at real interest rates. Basically, what real interest rate means is that you adjust the nominal interest rates by inflation. And a kind of more neutral sort of real rates is about 1%. Today, we're about 2%. So we're 100 basis points above the neutral rate, which means that, I mean, the Fed is still running a more tight policy. Where the Fed really wants to stimulate the economy, they will take the real rate to negative, and that's when that's during crisis areas, that's during kind of recessions when they would really cut interest rates to real interest rates to negative. So I think if there is no significant slowdown in the economy, it's very hard for the Fed to sort of to argue or to cut interest rates much faster than the market expects. The other thing I would like to draw attention to is with actually fiscal dominance, the impact from monetary policy, the impact from central banks is actually being crowded out by fiscal policies, meaning that Trump actually gets what he wants. What he actually puts out, what his policy does, has much bigger implications to the economy than what Powell does. And I think that is a new kind of maybe a new normal, a new kind of regime that we need to sort of adjust our expectations to because we're very, very used to reacting to central banks in terms of interest rate increases, decreases. I think going forward, I mean, the impact of that may be less and less. So I think one thing that is really manifesting is if you look at the yield curve, if you look at the difference between the long dated bonds versus the short dated bonds, that difference is actually widening. So even if the Fed cuts interest rates, I'm not sure it will bring the long end of the curve down. And that is actually important because if you think about what actually impacts the economy, what actually impacts mortgage, what actually impacts corporate lending is the long end, not necessarily the short end.
That's great. That leads me into my next question, actually. Anonymous viewer here on Zoom is asking, um, is it now a good time to lock in sort of longer durations, or is the risk of rate volatility still too high?
I think it depends on your expectation of returns. So if you think about fixed income instruments, it's fairly simple. You basically lend money to somebody in exchange for a return that you expect would beat or not beat inflation. And also, of course, on the premise that that person is going to return the money to you. So your principal is actually protected. And buying bonds is no different, right? Buying corporate bonds, I mean, you're basically lending money to a company. You make sure that company actually doesn't go bust. Buying government bonds basically is lending money to US government, and you have to have the faith that, I mean, the US government does not go bust and it will return the money to you. So today, I mean, if you look at the 10-year, or the 30-year, it's around 4.5, or even slightly higher. You have to ask yourself two questions, right? Number one, do you think inflation will be higher? So let's say we believe inflation will be 3% going forward. That means that the US government is giving you maybe 1 and 1.5% in addition to that 3% inflation. So your real return is actually 1 to 1.5%. Are you happy with it? If not, then you have to think about additional ways to get yield. So what are some of the additional ways to get yield? Number one is to extend duration. The second one is to go higher in your credit risk, meaning that you go to riskier companies that can give you more returns. The third way is to go to less liquid instruments. I think today, if you look at these three sources, the first source of going longer duration, yeah, gives you some additional return, but perhaps maybe not enough to kind of, I guess, compensate for the volatility or for the risk of the U.S. fiscal situation. A second way of going to like more corporates and more risky kind of lenders, if you look at the spread today, is actually very, very narrow. So you don't get quite compensated as well. So maybe the third way, which I guess unfortunately may not be accessible for all investors, but if you have access to it, going kind of more illiquid may be the better way to get yield. And I think Justin mentioned that we launched private credit, for example, in Singapore, Hong Kong, and Dubai. I think that is a very good way to get additional yield.
Great. Thanks, Steph. Maybe I think we're a bit over, so thanks everyone for sticking around. I see a number of you are still around, so maybe let's just end with one last question. There are a number of questions still. Our CE team will sort of help reach out to you guys if we haven't been able to answer. But the last question for the night, I guess. So this we sort of had our H2 outlook as a big part of this webinar. Escalade 89 is asking, sort of from your perspective, which do you think would have like a bigger impact in H2 20 of this year? You have on the one hand Trump tariffs, which are negative for growth, volatile for markets. On the other hand, you have the OBBB, the big beautiful budget
Mhm.
bill, which is stimulative. And you also have sort of those sort of deregulatory trends as well. How do you think about balancing those sort of downside risks and upside risks, or how do you think those will be balanced? I guess in the coming half year and period ahead.
Yeah. So I think all three would still be playing out in the coming years. And I guess if I have to think about kind of second half of the year, I think of course the big beautiful bill adds to kind of long-term concerns, but I mean that's been done, right? So markets actually have digested, and typically, I mean, whenever you have something that's done, like the market has digested already and move on. I think the next kind of big maybe milestone for markets is perhaps like the deregulation policies that hopefully would come out, because I mean that has potentially significant impact for some of the more cyclical or old economy sectors. Secondly, I think if you look at AI, the development is very, very real, and it's really accelerating every day. Today, I mean, just today, you've seen actually both OpenAI and also Perplexity announce that they've actually come up with a new browser. So if you think about that, it basically is eating Google's lunch in a very, very big way if they're successful. I mean, these things actually happen every day. And I think they have potentially pretty significant impacts on particularly on equity markets. So I would expect second half to be still like full of these kind of I guess positive surprises, hopefully. And in terms of I think what are the other assets that are interesting? I think gold has done very, very well this year. And if you look at kind of gold from a analyzed basis, it has gone up like kind of 50%, 60% analyzed year to date. So I think people would be looking for gold alternatives. If you look at silver, silver is also making new highs. I think like things like platinum, uranium, like all these hot assets are actually breaking out. Even I think Bitcoin or other crypto assets are looking likely that they may follow suit. And so I think if you think about the liquidity situation, it's actually very supportive for risky assets, but it just goes from one pocket to another pocket.
Oh, got it. Thanks, Steph. And I guess, yeah, let's leave it there. Maybe if you could click 3 slides down, sort of to end the night.
Actually, oh, I should probably show. Actually, why don't you end this first, and I'll show the poll results.
Sure. Just really quickly, thanks to those of you who have stuck around. We have a sort of an offer. If you scan this QR code or use this code here, H2 Outlook, you can sort of have, depending on the region that you are, sort of a few sort of months of free management from us as sort of a gift for taking your time out this evening to to listen to our outlook for the half year ahead. So yeah, again, H2 Outlook is the code, promo code, or you can scan this QR code now. And
Yep, and I think even if you missed
yeah,
this, I think you can probably like talk to one of our customer experience team members, and I'm sure they'd be more than
yeah,
happy to give you the free management fees.
yeah, exactly. So, yeah,
Um, so with that, maybe I'll just share the poll results so everybody has something to take home with. Let me switch my. All right. So I think everybody listened to me, so I'm very, very, very happy, and thank you so much for your support in terms of doing DCA. So most like 77% of us actually are going to start a DCA plan. So very, very glad to see that. 23% is going to wait to buy the dip. So in any case, hopefully you all get the chance to invest more and of course reap the benefit of compound interest and long-term investing. And thank you so much again for dialing in. I know like nighttime is also very, very busy for a lot of you. So thank you very much for spending the last kind of 1.5 hours with us. And with that, I guess we'll see you again in a few months' time.